Japan's declaration that a Chinese military action against Taiwan would constitute a survival-threatening situation for Tokyo has provoked a severe backlash from Beijing, with accusations of crossing a red line and immediate economic retaliations intensifying regional frictions. As of December 2025, China's imposition of travel advisories, seafood import bans, and cultural exchange restrictions signals the onset of a targeted trade dispute, eroding bilateral economic ties valued at over $300 billion annually. This escalation matters profoundly now, as it coincides with heightened vulnerabilities in global supply chains, particularly semiconductors reliant on Taiwanese production, amid already strained US-China relations. The fallout risks amplifying currency volatility, with the yen under pressure from policy divergences, and could precipitate broader market corrections if tensions spill into military posturing. Beneath the diplomatic rhetoric lie concealed perils: fragmented alliances that undermine multilateral stability and accelerated de-dollarization efforts among affected economies, fostering an environment prone to miscalculations with far-reaching financial consequences. In the midst of escalating tensions across the Indo-Pacific region, as of December 26, 2025, Japanese Prime Minister Sanae Takaichi's parliamentary statement on November 7 has precipitated a diplomatic crisis with profound implications for regional stability and global economic architectures. During a session in the National Diet, Takaichi articulated that a Chinese blockade or invasion of Taiwan would constitute a survival-threatening situation for Japan, invoking provisions under the country's revised security legislation that could authorize collective self-defense measures in alliance with partners like the United States. This pronouncement marks a deliberate departure from Tokyo's longstanding policy of strategic ambiguity regarding Taiwan, explicitly linking Japan's national security interests to the island's fate and signaling a heightened readiness to respond to potential aggression from Beijing. Rooted in the 2015 amendments to Japan's defense laws, which expanded the scope for self-defense forces engagement beyond direct attacks on Japanese soil, the statement underscores Tokyo's assessment of Taiwan's strategic proximity, mere 111 kilometers from Japan's westernmost islands, as integral to its own existential defenses. The legal framework invoked allows for military support to allies if such a crisis is deemed to threaten Japan's survival, potentially encompassing logistics, intelligence sharing, or even direct involvement in contingencies. This shift occurs against a backdrop of intensified US-China rivalries, where Washington's reaffirmed commitments under the Taiwan Relations Act intersect with Beijing's increasingly assertive military postures, including frequent incursions into Taiwan's air defense identification zone and live-fire exercises encircling the island. Takaichi's words, confirmed as ad-libbed in subsequent government disclosures, reflect a calculated move to deter escalation while aligning more overtly with the quadrilateral security dialogue partners, Australia, India, and the United States, in countering perceived expansionism. Yet this clarity amplifies risks in a theater where economic interdependencies, Japan's reliance on Taiwanese semiconductors for its automotive and electronics sectors, valued at trillions of yen annually, magnify the costs of any misstep. Geopolitically, Takaichi's declaration has ignited a cascade of retaliatory measures from Beijing, framing the incident as a violation of China's core interests, and prompting a multifaceted diplomatic offensive that tests the resilience of Indo-Pacific alliances. Chinese Foreign Minister Wang Yi's statement on November 23 labeled the remarks as shocking, demanding retraction, and invoking historical precedents of Japanese militarism to delegitimize Tokyo's position. By mid-December, this rhetoric has materialized into concrete actions, including a travel advisory urging Chinese nationals to avoid Japan, a renewed ban on Japanese seafood imports citing purported safety concerns, and suspensions of cultural exchanges, such as film releases and concerts, collectively targeting sectors integral to bilateral ties exceeding $300 billion in annual trade. These measures echo Beijing's playbook of economic coercion, previously deployed against Australia over South China Sea inquiries and South Korea amid THAAD deployments, leveraging market access as a lever to enforce red lines on Taiwan sovereignty. The crisis has spilled into multilateral forums, with exchanges at the United Nations, where Chinese representatives accused Japan of historical revisionism, met by Japanese countermeasures highlighting Beijing's non-adherence to post-war settlements like the San Francisco Peace Treaty, which left Taiwan's status unresolved without assigning it to the people. Ease Republic. Taiwan's government has expressed gratitude for the support, with Premier Cho Yong-tai noting it as a reaffirmation of shared values in maintaining cross-strait peace. Yet this solidarity risks drawing in additional actors, including potential Iranian escalations in parallel choke points that could indirectly strain global energy flows. The Quad framework, already navigating internal divergences on trade and technology policies, faces strains as misaligned crisis responses, such as India's cautious balancing with Beijing, could dilute collective deterrence, fostering a multipolar landscape where alliances fragment under pressure. Economically, Takaichi's statement embodies Tokyo's imperative to safeguard vital sea lanes that facilitate 90% of Japan's energy imports, traversing waters proximate to Taiwan, and thus vulnerable to any blockade scenarios that could disrupt liquefied natural gas shipments from Australia and the Middle East. Japan's strategic calculus integrates these dependencies with its position as a net importer in a region where supply chain resilience has become paramount, particularly amid ongoing US China decoupling efforts that have redirected investments towards Southeast Asia. The pronouncement aligns with Japan's 2022 national security strategy, which identifies China as the greatest strategic challenge and commits to bolstering defense spending to 2% of GDP by 2027, including acquisitions of counterstrike capabilities like Tomahawk missiles. This deterrence posture aims to mitigate risks from Beijing's military modernization, which has seen the People's Liberation Army Navy expand to over 370 vessels, dwarfing regional fleets and enabling sustained operations around Taiwan. However, the immediate fallout has manifested in market behaviors indicative of investor caution, with the yen depreciating past 155 against the dollar by late November, driven by fiscal doubts over Tokyo's expansionary spending plans and fading expectations for U.S. rate cuts that bolster the dollar's safe haven appeal. Broader indices like the Nikkei 225 have exhibited resilience, buoyed by diversified exposures in non-Asia markets, yet sectors sensitive to Chinese demand, tourism contributing over 5% to GDP, and seafood exports, valued at $1.2 billion annually, have seen stock declines of up to 5% in affected firms following Beijing's advisories. The Bank of Japan's recent rate hike to a 30-year high reflects efforts to stem this depreciation, yet verbal interventions from Takaichi, emphasizing appropriate responses to excessive movements, have yielded limited stabilization, as sentiment sours amid the diplomatic row. These fluctuations transmit through carry trades, where yen weakness has historically funded higher yield investments abroad, but now risks unwinding as geopolitical premiums elevate borrowing costs and prompt capital repatriation. Concealed within this crisis are layered consequences that could fracture deterrence mechanisms and exacerbate vulnerabilities in global technology ecosystems, particularly Taiwan's semiconductor sector, which commands 60% of the world's chip production and 92% of advanced nodes below 7 nanometers. Strains within the Quad, exemplified by Australia's measured diplomacy to preserve trade ties with China and India's focus on border disputes, risk misaligned crisis protocols, potentially diluting unified responses and emboldening Beijing's gray zone tactics, such as Coast Guard incursions around disputed islands. Amplified pressures on Taiwan Semiconductor Manufacturing Company, TSMC, already navigating U.S. export controls and domestic labor constraints, could manifest in production halts if tensions prompt evacuations or supply disruptions, as simulated in recent exercises projecting global economic losses exceeding $2 trillion from a blockade alone. Japanese firms like Sony and Toyota, reliant on these chips for automotive electronics and consumer goods, face inventory shortfalls that could cascade into manufacturing slowdowns, inflating costs amid yen weakness and compressing margins in export-oriented industries. Broader disruptions threaten AI and defense sectors, where advanced semiconductors underpin critical technologies, prompting accelerated onshoring initiatives under frameworks like the CHIPS Act, but exposing interim vulnerabilities in supply chains still concentrated in the Taiwan Strait. As Beijing's rhetoric sharpens, with spokespersons like Mao Ning and Lin Jian reiterating demands for retraction and lodging protests over Japanese officials' visits to Taiwan, the crisis illuminates the precarious equilibrium between deterrence and provocation in an economically intertwined region. Domestic voices in Japan, including Governor Amura's criticism of Takaichi's remarks as crossing lines, reveal internal fissures that could undermine policy cohesion, while China's invocation of wartime history seeks to isolate Toki. Diplomatically, the U.S. response, including high-profile bomber flights in support of Japan, affirms alliance commitments but stops short of concrete countermeasures to Beijing's economic levers, highlighting limitations in addressing hybrid threats. Liquidity strains emerge for Japanese firms in tourism and fisheries, with banking exposures to related loans potentially triggering feedback loops if defaults rise amid prolonged boycotts. Capital outflows from Asia-Pacific equities loom as risk aversion mounts, amplifying inflationary pass-throughs in energy-importing economies and constraining growth forecasts for 2026. This unfolding scenario demands vigilant monitoring of alliance dynamics and market indicators, as sustained tensions could catalyze realignments toward diversified reserves, hastening de-dollarization in regional trade and eroding established financial hegemonies. As geopolitical frictions in the Indo-Pacific intensify on December 26, 2025, China's deployment of targeted economic retaliation against Japan in response to Prime Minister Sanae Takaichi's November 7 statement on Taiwan represents a calculated escalation that leverages bilateral interdependencies to enforce Beijing's red lines on sovereignty issues. Initiated in mid-November, these measures encompass a multifaceted approach, beginning with a travel advisory issued by the Chinese Ministry of Foreign Affairs on November 15, discouraging citizens from visiting Japan due to purported safety concerns amid heightened diplomatic tensions. This advisory, framed as a precautionary step, has rapidly curtailed inbound tourism flows, a sector where Chinese visitors accounted for approximately 30% of Japan's pre-crisis arrivals, contributing significantly to an industry that generated over 5.3 trillion in 2023 and was on track for record highs in 2025, with projected inbound spending exceeding 9 trillion. Complementing this, Beijing imposed a ban on Japanese seafood imports effective November 18, citing unresolved safety issues related to Fukushima wastewater releases, despite international monitoring by the International Atomic Energy Agency affirming compliance with standards. This prohibition disrupts a trade segment valued at around yen 83.6 billion in 2022, with 2025 projections indicating a potential recovery to pre-ban levels before the measure's implementation, now forcing Japanese exporters to seek alternative markets amid stockpiles and price depressions. Further extending the retaliation, suspensions of cultural exchanges followed on November 20, including revocations of film licenses for Japanese productions and cancellations of concerts by prominent artists, impacting soft power avenues that facilitate annual bilateral engagements worth hundreds of millions in ancillary economic activity. These actions, collectively affecting sectors integral to Japan's export portfolio, are positioned by Chinese officials as proportionate responses to perceived interference in Taiwan affairs, invoking historical sensitivities to justify the measures while avoiding broader trade disruptions that could invite multilateral backlash. The geopolitical underpinnings of this retaliation reveal Beijing's strategic employment of economic coercion as a tool to delineate and enforce boundaries on Taiwan-related discourse, mirroring precedents in disputes with Australia over South China Sea inquiries in 2020 and South Korea amid the terminal high-altitude area defense deployment in 2017, where similar bans on commodities and tourism inflicted measurable fiscal pressures. In the current context, Takaichi's ad-libbed remarks during a parliamentary session, declaring a Chinese military action against Taiwan as a survival-threatening situation for Japan under revised security laws, have been interpreted by Beijing as a direct challenge to the One China principle, prompting a calibrated response that signals intolerance for shifts in Tokyo's traditional ambiguity. This approach exploits Japan's structural dependencies. Tourism, which supports around 6 million jobs and contributed zero point 0.4 percentage points to GDP growth in 2023, now faces a projected contraction of up to 15% in Chinese visitor spending for the fourth quarter of 2025, exacerbating vulnerabilities in a post-pandemic recovery reliant on inbound flows exceeding 21.5 million arrivals in the first half of the year. Seafood exports, a niche but symbolically charged segment, underscore Beijing's precision in targeting politically resonant areas, with the ban echoing the 2023 suspension that reduced shipments by 57% in fiscal year 2023, forcing diversification to markets like the United States and Europe, but at lower margins due to transportation costs and quality mismatches. Cultural suspensions, while less quantifiable, erode people to people ties that underpin economic resilience, potentially diminishing long term investment flows from China, which ranked as Japan's largest trading partner. With bilateral volumes surpassing $300 billion in 2024. This pattern of coercion not only reinforces Beijing's narrative of external interference, but also tests the cohesion of US led alliances, where Japan's overt alignment risks isolating it from neutral actors in ASEAN wary of entanglement in cross strait issues. Economically, these retaliatory steps capitalize on Japan's export oriented model, where dependencies on the Chinese market, absorbing 20% of total exports, amplify the transmission of disruptions into domestic fiscal strains. The travel advisory has precipitated a sharp decline in bookings, with estimates from the Japan National Tourism Organization indicating a 40% drop in Chinese arrivals for December, a peak season typically generating 470 billion in outbound spending projections for 2025. This impacts hospitality chains and retail conglomerates, where pre-crisis data showed Chinese tourists spending an average of 250,000 per trip, far exceeding other nationalities, now forcing inventory overhangs and revenue shortfalls that could shave zero point 0.2 percentage points off quarterly GDP growth if protracted. The seafood ban, resuming after a brief 2025 resumption in May, affects processors in Hokkaido and Tohoku regions, with export values plummeting from 74.6 billion in 2022 to projected lows under 30 billion annualized, compelling rerouting to domestic markets and resulting in price deflation that squeezes producer margins by up to 25%. Cultural halts, including the revocation of licenses for anime and J-pop events, disrupt a niche trade worth yen 50 billion annually, indirectly affecting intellectual property revenues and joint ventures in entertainment that foster economic goodwill. Beijing's framing of these as responses to internal affairs interference aligns with its hybrid warfare doctrine, blending economic tools with diplomatic isolation to impose costs without kinetic escalation, thereby deterring further pronouncements from Tokyo while preserving plausible deniability in multilateral trade forums like the World Trade Organization. Market reactions to this unfolding retaliation have been swift and sector-specific, with Japanese tourism and retail equities experiencing declines of up to 5% in trading sessions immediately following the announcements, as evidenced by drops in shares of major operators like JTB and HIS, reflecting soured investor sentiment on the prospects of prolonged bilateral chill. The Nikkei 225 index, while resilient overall due to gains in technology and manufacturing, has seen volatility spikes, with implied options premiums rising 15% amid hedging against tail risks of further measures, such as rare earth export curbs speculated in Chinese media but not yet materialized. Currency markets have amplified these pressures, with the yen depreciating to levels near 155 against the dollar by late November, driven by risk aversion flows toward U.S. assets and diminishing carry trade attractiveness as geopolitical premiums elevate funding costs. Broader Asian indices, including the Hang Seng and Shanghai Composite, have exhibited correlated dips, underscoring the contagion potential in interdependent financial ecosystems, where Japanese investments in China exceed $130 billion cumulatively. Investor discourse on platforms highlights concerns over supply chain exposures, with calls for accelerated diversification echoing in analyses from think tanks like the Observer Research Foundation, noting the risks of de-risking strategies that could add trillions in relocation costs over the next decade. These reactions are tempered by Japan's fiscal buffers, including foreign reserves surpassing $1.2 trillion. Yet sustained disruptions could erode corporate earnings in affected sectors by 10 to 20% quarterly, prompting credit rating agencies to monitor sovereign downgrades amid rising defense expenditures. Beneath the immediate economic dislocations lie systemic risks that could engender liquidity strains for firms in targeted industries, potential capital outflows from Japanese equities, and pernicious feedback loops in banking systems laden with tourism related exposures. Small and medium enterprises in hospitality, comprising 80% of the sector, face acute cash flow pressures from canceled bookings, with estimates indicating liquidity shortfalls of 100 billion in the fourth quarter alone, necessitating bridge financing that strains regional banks already navigating negative interest rate legacies. Capital outflows, accelerated by foreign institutional investors reallocating from Asia Pacific assets amid heightened risk premiums, have seen net sales of 500 billion in Japanese stocks since mid-November, exacerbating yen weakness and inflating import costs for energy and raw materials in an economy importing 90% of its oil. Banking feedback loops emerge as non-performing loans in tourism portfolios rise, with exposure ratios institutions like Mitsubishi UFJ reaching 5% of total lending, potentially triggering provisioning requirements that constrain credit extension and dampen broader growth. These perils extend regionally, where interdependent supply chains, particularly in electronics and automotive, reliant on cross-border components, face rerouting costs estimated at 2 to 3% of value added, fostering inflationary impulses in downstream markets. The retaliation's design, avoiding comprehensive tariffs to evade WTO scrutiny, nonetheless catalyzes long-term fragmentation. As Japanese multinationals accelerate China plus one strategies, investing in Vietnam and India, but incurring transitional inefficiencies that could shave zero point 0.5 percentage points off annual GDP over 5 years. This ongoing retaliation illuminates profound vulnerabilities in interdependent economies, where punitive economic tools not only impose immediate costs, but also propel structural shifts toward diversified trade architectures, potentially diminishing China's leverage over time while heightening global fragmentation risks. As diplomatic channels remain strained without concessions, evidenced by continued protests and UN exchanges, Beijing's measures may inadvertently bolster Japan's resolve to deepen alliances, including enhanced intelligence sharing with the Five Eyes network and joint exercises with Quad partners. For Japan, the fiscal toll could necessitate supplementary budgets, with tourism losses alone projected at 1 trillion if the advisory persists into 2026, straining a debt-to-GDP ratio exceeding 250% and prompting yield pressures on government bonds. Regionally, this dynamic encourages ASEAN neutrality, as economies like Indonesia and Malaysia balance Chinese investments against U.S. security guarantees, potentially leading to bifurcated trade blocs that elevate transaction costs by 10 to 15% in affected corridors. The broader implication is a reconfiguration of Indo-Pacific economic equilibria, where sustained coercion accelerates de-risking, fostering resilient but fragmented networks that undermine multilateral institutions and heighten the probability of inadvertent escalations amid misaligned incentives. Intelligence assessments must prioritize tracking trade flow diversions and alliance cohesions, as these elements shape the trajectory of this crisis in real time. In the volatile geopolitical theater of the Indo-Pacific as of December 26, 2025, the escalating tensions between China and Japan, triggered by Prime Minister Sanae Takaichi's November 7 parliamentary declaration linking a potential Chinese military action against Taiwan to Japan's existential security, are injecting profound volatility into global financial markets, compelling investors to adopt defensive postures amid fears of cascading disruptions to critical supply chains. Takaichi's statement, which invoked Japan's revised security legislation to frame such an event as a survival-threatening situation, warranting collective defense measures, has elicited a sharp retaliatory response from Beijing, including travel advisories, renewed bans on Japanese seafood imports, and suspensions of cultural exchanges, measures that echo China's established pattern of economic coercion, as seen in prior disputes with Australia and South Korea. This diplomatic impasse, now extending into the United Nations, with mutual accusations of historical revisionism and interference in internal affairs, underscores a deepening rift that amplifies systemic risks in an already fragmented global order. Investors, attuned to the interplay of rhetoric and reprisals, are increasingly hedging through derivatives markets, with options trading volumes on Nikkei futures surging by 20% since mid November, reflecting embedded premiums for tail risk scenarios where cross strait instability disrupts trade flows valued at trillions annually. The yen, under sustained pressure from safe haven flows toward the US dollar, has depreciated to levels beyond 155 per dollar, exacerbating import costs for Japan's energy dependent economy and signaling broader currency market unease amid policy divergences between the Bank of Japan's tightening cycle and the Federal Reserve's anticipated rate cuts. Concurrently, Japanese government bond yields have climbed to multi-decade highs, with the 10-year benchmark reaching 1.25% following the Bank of Japan's quarter-point rate hike to 0.75% on December 19, a move driven by fiscal expansion concerns and the need to curb yen weakness, yet one that heightens borrowing costs for a government grappling with a debt-to-GDP ratio exceeding 250%. These market movements are not isolated. They reverberate through Asia-Pacific equities, where net foreign outflows from Japanese stocks have totaled 500 billion since the crisis onset, as institutional funds reallocate toward perceived stability in US treasuries, underscoring the contagion potential in a region where economic interlinkages amplify exogenous shocks. At the core of this volatility lies Taiwan's pivotal role in global supply chains, particularly its commanding 92% market share in sub-7 nanometer semiconductor production, a dominance led by Taiwan Semiconductor Manufacturing Company, TSMC, that renders the island indispensable for advanced technologies underpinning artificial intelligence, defense systems, and consumer electronics. Economic logic posits that any escalation, whether through blockade simulations or heightened military patrols, would precipitate immediate elevations in production costs and shipment delays, as TSMC's facilities, concentrated in Taiwan's western plains, face evacuation risks that could halt output for weeks, with global economic fallout estimated at $2 trillion in a protracted scenario, according to recent war game analyses. TSMC's advanced nodes, accounting for 74% of its revenue from sub-7 nm processes in the third quarter of 2025, supply critical components to firms like Nvidia and Apple, where even minor interruptions could cascade into shortages amplifying inflationary pressures in tech-dependent economies such as South Korea and the United States, where semiconductor imports constitute 15% of high-tech trade volumes. The fragility is compounded by Taiwan's geographic vulnerabilities, with recent evacuations during typhoon seasons highlighting operational risks that, in a conflict context, could strand inventories and force rerouting through less efficient channels, adding 5 to 10% to logistics costs for downstream manufacturers. Japan's own exposure is acute, with Taiwanese chips integral to its automotive sector. Toyota and Honda rely on them for electronic control units, potentially delaying assembly lines and eroding export competitiveness amid yen depreciation that already inflates component prices by 8% year over year. Broader supply chain interdependencies extend to rare earth elements and precision machinery, where China's dominance in upstream materials, supplying 80% of global neodymium for chip magnets, intersects with retaliatory measures like the seafood ban, signaling potential for wider commodity restrictions that could inflate input costs by 20% in affected industries. This economic calculus drives investor hedging, with increased allocations to gold and U.S. Treasuries as proxies for stability, while options implied volatility on the Nikkei has spiked to 25%, embedding premiums for scenarios where Taiwan's Strait disruptions have global chip output for months. Geopolitically, the Sino-Japanese standoff is cultivating a multipolar risk landscape characterized by potential fragmentation in allied responses, where divergences within the quadrilateral security dialogue, encompassing Japan, the United States, Australia, and India, could undermine collective deterrence efficacy amid Beijing's gray zone tactics. India's cautious balancing, prioritizing border disputes with China while maintaining economic ties, contrasts with Australia's more vocal alignment with Tokyo, potentially leading to miscoordinated crisis protocols that dilute unified signaling and embolden incremental encroachments around Taiwan and the Senkaku Islands. This fragmentation is evident in recent Shangri-La dialogue outcomes, where subtle shifts toward bilateral, rather than multilateral engagements, highlight institutional drift in the face of rising geopolitical tensions. Currency markets bear the imprint of these dynamics, with the yen's weakening, down 11% against the dollar in 2025, accelerated by safe haven outflows as investors anticipate prolonged instability, transmitting pressures to emerging Asian currencies like the South Korean won, which has depreciated 7% in tandem amid shared supply chain exposures. The BlackRock Geopolitical Risk Indicator, registering levels above Cold War averages, captures this elevated attention, with Indo Pacific fragmentation contributing to a 15% rise in the index since November, signaling broader implications for transatlantic alliances, where U.S. commitments may stretch thin amid concurrent Middle Eastern and European contingencies. Beijing's deterioration in peripheral security, marked by tightened alliances with Russia and increased military activities in the South China Sea, further entrenches this multipolarity, limiting strategic initiative and fostering environments where miscalculations, such as unintended naval encounters, could escalate into kinetic exchanges with cascading economic fallout. For Japan, this landscape necessitates enhanced defense outlays, as evidenced by the record yen 122, 3 trillion fiscal 2026 budget approved on December 26, allocating an unprecedented yen 9.04 trillion to military spending, a move that strains fiscal balances and elevates bond yields amid market skepticism over sustainable funding. Market behaviors in this environment reveal a sophisticated layering of risk premia, with heightened options trading on Nikkei futures, volumes up 25% in December, indicating investor preparations for volatility spikes akin to those observed during the 2022 Ukraine invasion, where tail risks materialized into double-digit index corrections. Bond yields in Japan have edged higher, with the 10-year rate climbing to 1.3% post the Bank of Japan's December 19 hike, reflecting fiscal strain concerns as expansionary spending, projected deficits at 3.5% of GDP, intersects with geopolitical uncertainties that deter foreign inflows into government securities. This yield ascent, narrowing the spread with U.S. Treasuries to 2.12 percentage points, signals a reevaluation of Japan's safe asset status, potentially amplifying transmission to global fixed income markets, where Japanese institutional investors hold $3 trillion in foreign bonds, susceptible to repatriation flows during crises. Equity markets, while resilient with the Nikkei closing 1% higher on December 19 amid broader Asian gains, mask sector-specific vulnerabilities. Tourism and retail stocks have slid 5% since mid-November, as China's advisory reduces visitor projections by 40%, compressing earnings for operators reliant on inbound spending that reached 9 trillion pre-crisis. These behaviors are echoed in social media sentiment, where discussions on platforms highlight fears of market corrections driven by Sino-Japanese frictions, with users citing yen weakness and alliance strains as harbingers of broader downturns. Institutional repositioning, including increased short positions on yen forwards, further illustrates this hedging imperative, as funds anticipate volatility indices climbing to 30 amid unresolved diplomatic strains. Concealed perils within this matrix encompass abrupt capital reallocations from Asia-Pacific equities, which could deplete liquidity in regional exchanges and amplify inflationary pressures in economies heavily reliant on technology imports. Foreign institutional net sales of Japanese stocks have accelerated to 1 trillion in December, redirecting toward US and European assets perceived as insulated from Indo-Pacific risks, a flow that thins market depth and heightens susceptibility to exogenous shocks. In tech-dependent jurisdictions like Germany and the Netherlands, where Taiwanese chips underpin automotive and machinery sectors, inflationary impulses from supply delays could add 1 to 2 percentage points to core rates, as input costs rise 15% amid rerouting through U.S. fabs still scaling under the CHIPS Act. Systemic banking exposures to cross-border loans vulnerable to trade halts pose another layer of risk, with Japanese megabanks holding yen 20 trillion in Asia-Pacific commitments, including facilities to Taiwanese firms, where default probabilities could spike 200 basis points in escalation scenarios, triggering provisioning that constrains credit growth by 5% regionally. These interlinkages extend to petrodollar frameworks, where Indo-Pacific instability intersects with energy dependencies. Japan's 90% oil import reliance via Taiwan-adjacent lanes, potentially elevating crude premiums by $10 per barrel, transmitting to global inflation and eroding dollar reserve attractiveness as central banks diversify holdings amid fragmentation. The Global Peace Index 2025 notes geopolitical fragmentation surpassing Cold War levels, with Indo-Pacific metrics deteriorating 12% year-over-year, underscoring environments ripe for capital flight and reserve shifts toward gold, which has appreciated 25% in 2025. As diplomatic channels remain strained without substantive resolution, evidenced by ongoing United Nations sparring and China's refusal to retract advisories. These dynamics accentuate the inherent fragility of petrodollar and tech-centric global architectures, catalyzing imperatives for diversified reserves and accelerated onshoring to buffer against persistent uncertainties. Central banks in the region, including the Reserve Bank of Australia and Bank of Korea, have incrementally boosted gold allocations by 10% since November, hedging against dollar volatility tied to US-China frictions that spill into Indo-Pacific theaters. Onshoring initiatives, bolstered by frameworks like the US-India ICET and Japan's 2 trillion subsidy program for domestic chip fabrication, aim to redistribute production risks, yet transitional costs, estimated at $1 trillion globally over 5 years, could constrain corporate capex and dampen growth forecasts to 2.5% for Asia in 2026. Japan's record yen 122, 3 trillion fiscal 2026 budget, with 9.04 trillion earmarked for defense amid these tensions, exemplifies this pivot, yet it exacerbates yield pressures and fiscal strains that could feed back into higher sovereign borrowing premiums. Broader realignments, including ASEAN's neutral hedging through enhanced RCEP engagement. ENTs foster fragmented trade blocs that elevate transaction frictions by 5%, undermining multilateral efficiency and heightening the probability of inadvertent escalations. Intelligence imperatives demand continuous surveillance of alliance cohesions and reserve compositions as these tensions evolve in real time, potentially reshaping economic equilibria toward a more balkanized global order.